Hey, what's going on YouTube? We're gonna go through Starbucks, ticker symbol SBUX. Recently, company has hit or just bounced off a 52-week low of $84.29. And since then, it has bounced off that 52-week low. So what we're going to do, we're going to go through valuation spreadsheet, the financials on the company. We're going to look through all of their previous financials and see how the company's trending overall. Then we're going to look through a couple key points in their most recent report, their most recent earnings report, that is, which was reported January 30th. And their next report is actually next week, April 30th. And with that report too, EPS revisions, 26 revisions in the last 90 days have been revised lower on their EPS expectations. So something to keep in mind as well, which also contributes to why the stock is hitting 52-week lows currently. And then after that, we'll look at the stock chart, and also we will figure out what this thing is worth and what a fair market value is on Starbucks. So let's get into it. So right now we're looking at revenue, gross profit, net income chart here, all three trend lines. And we can see revenue, I would say, is starting to flatline. It's maybe wanting to pull back a little bit, kind of like that, we'll see. But that's kind of what I'm seeing, is a little bit of, we're starting to level off quite a bit as of lately on revenue. So maybe that's a question we want answered, is to figure out, okay, what are you guys going to do to continue to grow your revenues in order for us to want to pay a bit of a premium for this company. Next, we got net income. We can see if you draw a line from this point to this point, I would say we're just getting back on trend. We had some humps and dips in here, but I think overall getting back in line with where the overall trend has been on this company. Gross margins, historically, in 2015, we were at 31%, and today we're 27.5%. So we have seen a little bit of some slip on some gross margins. And net margins, looks like that went from 14.4 down to about 11% range. So I would say 3% range or drop from here got pulled over to here. So yeah, their gross margins did impact their overall net margins as well. So we got down here, return on invested capital, historically about 30%, and they're getting back into that 30% range where they've been in the past. So that's very good. Good return on invested capital. We got a PE ratio today, 23.4. And historically, again, not too bad. We're at the lower end of their historic PE ratio. But again, if their revenues start to fall over, this PE is going to continue to drop as well. You're not going to want to pay, investors aren't going to want to pay as high of a premium for this company if their overall revenues and the overall company isn't going to grow at such a quick rate. We're going to see our PE ratios come down, probably potentially get cut in half, who knows. So we come down here, we got cash to short-term debt. We can see company does have quite a bit of debt. And we come down here to cash to total debt. Company has a lot of total debt. So that's another thing we want answered as well, or at least dig into, understand maybe there's a few things, some deferred revs that we can pull out of here to maybe make their debt position not so terrible compared to their cash position, to have a better cash to debt ratio. And earnings yield sitting at about 4.3%, and not terrible. We got net income to free cash flow. And historically, their free cash flows to net income are relatively in line with one another. So, and overall, they have continued to grow. There's a little bit of a trend up higher on cash flows. So that's good. And then we got free cash flows by themselves. $2.4 billion in 2015, today, $4.4 billion. And share count dilution, we are seeing shares continue to get bought at this company. We do have dividends that are increasing. It looks like year over year dividend increases as of the last, at least 8 years there. So now in their most recent report here, this is on their earnings summary. In their summary, they did mention they opened 549 new stores in Q1. So there's their stores grow, their revenue should also follow, right? So hopefully that is going to continue to grow. They're going to open more stores and revenues will continue to grow as well. Now, in their guidance for 2024, they mentioned that they are confident that the business pressures that they are experienced in first quarter are transitory. So they're still seeing issues, and they're forecasting, still guiding that these issues aren't gone yet. They're going to be here for a little while. They do see them going away, but potentially not anytime real soon. And we come down here, they're expecting their full year global revenue growth in the range of 7 to 10%. However, they previously guided 10 to 12%. So they guided even lower on their revenues. So that's not exactly a very bullish sign for this company in the shorter term until those transitory business pressures that they've got going on are resolved or just fade away, whatever the case is that's going on there. So you got those two things kind of weighing down on the company, which is why we're probably seeing 52-week lows right now on StarBucks. Now over to their 10Q, their most recent report. We got total net revenues. Year over year, they're up 8.1% to $9.4 billion in revenues there. Total operating expenses up 6.3% year over year. We have a net earnings are up year over year also by about 19% there. And we do see right here that our overall shares outstanding are obviously we've already seen that, but now are still continuing to get bought back as well. So that is nice to see. And one of the things that we also saw going through this 10Q was cash and cash equivalents. You can see last year, or actually last quarter, $3.55 billion in cash, now sitting at $3 billion in cash. Okay, we want to know, where did that $551 million go? We don't want to just see that your cash position disappear, especially when you have such a low cash to debt ratio. We want to see more and more cash, not cash getting burned. That usually comes with a bit of a red flag. So something we want an answer to as we go through these, go to the cash flows and figure out where the cash flowed, and maybe get an understanding where that went. So we come down here to current liabilities. This is one of the answers we want to see, is see if there's something out of this debt column that we can eliminate to make debts look better against the cash position. So there are a few things we can cross off here. We have current portion of operating lease liabilities. We can pull those out if we want. We have current portion of deferred revs of $2.2 billion. Again, deferred revenues, we can pull those out. And down here, we have the same thing for long-term debts as well. So in total, we could remove about $16 billion in total debt if you add all three of these or all four of these columns up. That's roughly what you could eliminate out of there. But overall, we can see that we can potentially pull out about $16 billion, which leaves them with about $21 billion in total debts in comparison to our cash position of, maybe you could call it 3.5-ish billion dollars up there. You got, your cash plus short-term investments. You do have accounts receivable as well that will eventually get put into cash there. But overall, you're looking at about currently $3.4 billion in cash compared to $21 billion in total debts. But in the short term here, short-term debts, you're looking at about $6-ish billion that they've got to pay. So they've got about a 0.5 to 1 cash to debt ratio over from short-term cash to debt position. So now we come down to our cash flows. We've got net earnings with $1 billion. We come down here, we got stock-based compensation, $94.8 million in stock-based comp, not too bad at all there. And overall, after all the cash flows in and out of the business here, we're left with $2.4 billion in cash from operations in total. We have to subtract out $600 million in CapEx. And then if we annualize these numbers here, we're looking at about $7.2 billion in free cash flow annualized. That would definitely give them plenty of room to continue to grow that dividend as well. So that kind of gives us a real quick idea that dividend is safe. So what we do though is we take our $2.4 billion provided by operating activities minus off $569 million of cash used in investing activities. Then we also subtract out $2.4 billion cash used in financing activities down here as well. And in this $2.4 billion, $1.26 billion of that was used to repurchase common stock. And because of this right here, that's why we saw a loss on their overall cash position of $551 million. They bought back so many shares. They bought back maybe more than they wanted to, or maybe they just found it to be a good idea to use a little bit of cash on their balance sheet. And now that's why we see a reduction in overall cash position from 3.55 billion down to $3 billion in cash. So not a bad thing that's where that cash went to. It wasn't for any other reason that would potentially scare investors going forward. That's I think an acceptable spend of cash. So now over back to our valuation spreadsheet. Now we want to know what this thing is worth. So right off the bat here, we got StarBucks. We have Peter Lynch valuation gives them $59.71. Multiples comparison, the only thing I could really think of is maybe McDonald's. You could say argue that okay, instead of going to Starbucks for coffee, I'll go to McDonald's for coffee. That would be my potential argument on that. Otherwise, you can maybe pull this one out of the equation, but being that it's McDonald's and it's trading, our valuation multiples comparison is really close to our current value. I'm not too concerned about having that as a comparison in this formula that we got. Price to book, we're negative because we do have a lot more debts than we do cash. So that's why we got overall negative price to book right now. Peg ratio, forward looking, sitting at about a 2 peg. Grams valuation gives them $106.45 per share. Dividend discount model, $92.90 per share. Then we come over here to our DCF valuation. Currently, their growth rate on free cash flow is expected to be about 14%. So that's a very good free cash flow growth rate. That gives them DCF price per share of $125.06. Then we come down here to Rule 72. We have EPS growth for a pretty solid average around 16%. And with that 16%, we could then double our current EPS 2.2 times, which puts us at about a 16 for future earnings per share, which gives us a fair value of $127.84. So overall, we get a fair market value of $100 on this company. 30% margin safety would be $70, and let's have a price target of $108 per share. So let me come over here to our stock chart. We can see Starbucks trading $88 per share. Our fair market value is $70 per share down here. There is a bit of support down here. You could argue that there is. I really highly doubt we'll see a 30% margin safety on Starbucks. That'd be cool. But I think something really bad would probably have to happen. Maybe we actually go into a recession or something like that. Maybe that's when could potentially see Starbucks get down to $70 a share. But in the shorter term here, what we're seeing in the macro trend is Starbucks is making lower highs, but we're still making higher lows. This is on the weekly chart, but we can see 52-week lows bounce right off this red trend line. This trend line goes all the way back to 2009. Every time we get to this trend line, we bounce up higher, bounce off this red trend line. So I think this is a very solid support for this stock. We do have resistance on this yellow line. We do have some support here on this green line. So earnings are in 8 days on this company. We can see right here. Maybe earnings come back and maybe push this thing down a couple more dollars, get us maybe to this green line, pierce through this red line for a hot second, and then maybe resume back up higher, retest that yellow line again in the future. So I think in the shorter term, now is probably a pretty decent buying opportunity. I wouldn't go all in on it. I'd probably wait till after earnings, because maybe after earnings, we do see a little bit of a pullback on this one to where we could pull back to $84, $82 range on Starbucks. Then that I think would be a pretty good buying opportunity on Starbucks. That's probably when I go 100% position size on Starbucks for this one. And probably see a pretty quick bounce, as we can see in the past. Every time we pierce through, we see a pretty quick bounce on Starbucks going back up to new highs, or at least back up to trend. And in this case, we'd probably see a potential bounce up to $98 to $100 per share, depending on how quickly it does it. So, and who knows, maybe it bounces right through and continues higher and gets back up to maybe 115-ish per share on Starbucks. But that is it for Starbucks. If you found value in this video, drop a like, subscribe, comment. We'll be back later with another stock analysis video.